Welcome to the Tesla Daily News Podcast. It's Wednesday, January 21st, 2026. Today, we're tracking a big pivot in Tesla's AI compute plans, fresh regulatory pressure on full self-driving, a notable demand signal for Model Y in China, and a couple of distribution and policy updates that could move Tesla's revenue, margins, and sentiment. Let's jump in. Story 1. Tesla is rebooting Dojo 3, and it's not just a science project anymore. The hook is simple. Elon Musk says Dojo 3 is back because Tesla's next generation in-car AI chip, AI5, is now in good shape. Here's the context. Tesla's valuation has long carried a software and autonomy premium. To justify that premium, Tesla needs a cost-effective way to train and improve driving and robotics models at scale. Training compute is expensive, and most of the AI world is renting time on NVIDIA hardware. If Tesla can build a competitive training stack in-house, it potentially lowers cost per unit of AI progress and protects Tesla from supply constraints. The details from today's reports. The Dojo effort was paused after the specialized team was disbanded last year, while Tesla prioritized AI5 and AI6 chips for vehicles and for robotics. Now, Musk is saying the AI5 chip design is far enough along that Dojo 3 work can restart. Multiple outlets also point to manufacturing partners including TSMC and Samsung for chip production, with at least one report mentioning Intel packaging work, important because advanced packaging can be a bottleneck for high-performance chips. The investor impact. This is a sentiment catalyst. Bulls will hear vertical integration and better performance per dollar as a potential wedge against NVIDIA dependence. Bears will hear capital intensity and execution risk. The key question for Tesla is whether Dojo materially improves time to improvement for FSD and Optimus while keeping compute costs under control. If Tesla's AI training costs trend down versus peers, that can support higher software gross margins over time. Takeaway. Treat Dojo 3 as a medium-term lever on autonomy economics. Watch for concrete metrics, training throughput, cost per training run, and how quickly FSD and Optimus capabilities improve after the restart. Story 2. U.S. regulators are turning up the heat on FSD incident disclosure. The hook. The National Highway Traffic Safety Administration is demanding a significant information dump from Tesla related to full self-driving behavior after complaints around traffic law violations. Context. For Tesla investors, regulation is one of the biggest swing factors for the autonomy narrative. Even if the tech improves, tighter oversight can slow deployment, raise compliance costs, or shape how Tesla markets and monetizes FSD. Details reported. NHTSA has requested extensive information tied to FSD after multiple complaints, including allegations of ignoring traffic lights and crossing into oncoming lanes. Tesla reportedly received roughly a 5-week extension to respond, but the agency wants detailed incident reporting, essentially pushing Tesla toward more transparency around failures and edge case behavior. Impact. Near term. This can pressure sentiment and increase headline risk, especially if there are high-profile incidents or if Tesla's disclosures prompt follow-up actions. Longer term, though, a standardized disclosure regime could cut both ways. If Tesla can show improving safety performance with clean data, that helps the investment case. If not, it could constrain rollout pace. Takeaway. Watch the timeline. Over the next month or so, the risk is negative headlines. Over the next quarter or two, the market will care about whether this becomes a formal investigation escalation or stays in the information request lane. Story 3. Model Y remains a demand anchor in China, and the numbers still matter. The hook. Retail data out of China lists the Tesla Model Y as the top-selling SUV for full year 2025, with 425,337 units. Context. China is Tesla's most competitive battlefield, high EV penetration, aggressive local players, and frequent pricing pressure. Strong Model Y volume is critical because it supports factory utilization and fixed cost absorption, both of which flow directly into automotive gross margin. Details. Chinese retail SUV sales for 2025 totaled about 11.878 million units, up 5.0% year-over-year. Within that, Model Y's 425,000 plus units put it at the top of the SUV ranking referenced in the report. Impact. This is a positive data point for Tesla's positioning in the world's largest EV market, even in a crowded field. But investors should keep it balanced. Leadership in units doesn't automatically mean leadership in profitability. If Tesla is defending share through pricing, the margin story can still be challenged. Takeaway. Model Y's volume leadership supports the durability argument for Tesla's core lineup. The next investor question is whether Tesla can hold this volume while improving margins through manufacturing efficiency, lower battery costs, or software attach. Story 4. Tesla is leaning further into recurring revenue with FSD. The hook. Tesla is reportedly shifting full self-driving away from a one-time purchase and toward a monthly subscription-first model. Context. Wall Street often assigns higher multiples to recurring, subscription-like revenue because it's more predictable and can scale with software margins. Tesla already offers subscription options, but moving the center of gravity away from the big upfront sale changes near-term cash flow timing and the way investors model take rates. Details. Coverage indicates Tesla is de-emphasizing the lifetime, one-off purchase, and pushing a monthly plan as the primary way customers access FSD. Impact. In the short term, this could reduce the size of one-time revenue spikes when customers buy FSD outright. But if subscription adoption rises, it can increase lifetime value per vehicle and smooth revenue over time, particularly meaningful if Tesla expands the addressable base through lower monthly pricing or broader geographic availability. Takeaway. Watch attach rate and churn. The market will want to see how many buyers actually subscribe, how long they keep it, and whether Tesla can bundle it intelligently with connectivity, insurance, or future robotaxi offerings. Story 5. Supercharging keeps expanding its distribution advantage, now with host-branded sites. The hook. Wawa, Tesla's largest supercharger host, has launched its first self-branded supercharger site under Tesla's Supercharger for Business program. Context. Charging convenience is still a key differentiator for EV adoption, and Tesla's network increasingly acts like both a moat and a monetization platform. Host-branded deployments matter because they can accelerate rollout without Tesla owning every piece of the real estate branding experience. Details. Wawa joined Tesla's business program and rolled out a Wawa-branded supercharger location, effectively a deeper partnership with a major retail operator. Impact. More sites in high-traffic corridors can drive higher utilization, improve customer satisfaction, and reduce range anxiety, supporting vehicle demand. For investors, the bigger angle is network economics. More utilization can improve the return profile of charging assets, and business partnerships can reduce deployment friction. Takeaway. It's not a quarter-changing event on its own, but it reinforces Tesla's infrastructure lead, which helps protect demand, especially when competitors are discounting vehicles. Story 6. Macro and policy crosscurrents in Europe are getting more competitive. The hook. Germany is reinstating EV subsidies under a multi-year program, and reports indicate incentives will be open to all manufacturers, including Chinese brands. Context. Europe is a margin-sensitive region for Tesla, and incentives can swing demand quickly. But if subsidies are brand neutral, they don't automatically favor Tesla, especially when lower-priced competitors qualify. Details. Reporting describes a €3 billion program running into the late 2020s, with per-buyer subsidies ranging from about €1,500 to €6,000. Impact. This could lift overall EV demand in Germany, which is good for the category. But it may intensify price competition if multiple brands use subsidies to get more aggressive on sticker prices. For Tesla, the investor question becomes, does Tesla win on total cost of ownership and charging convenience, or do competitors take share on upfront affordability? Takeaway. Subsidies can expand the market, but they can also compress margins if the fight becomes price-led. Watch Tesla's pricing strategy in Europe and any signs of renewed discounting. Now let's tie it together for investors. Today's throughline is AI and autonomy versus oversight and competition. Tesla is signaling renewed momentum on the infrastructure needed to train autonomy and robotics, Dojo 3, and the AI 5 chip pipeline. At the same time, regulators are demanding more disclosure around FSD behavior, and competitive pressure remains intense in key markets. For tomorrow, keep an eye on two things. First, any additional detail from Tesla or suppliers that turns Dojo from a headline into a schedule and a budget, and second, any incremental updates on the NHTSA information request, because regulatory tone can move the stock quickly. If you found this useful, subscribe to Tesla Daily News Podcast for your daily, investor-focused roundup, and follow us for the next episode.